Looking at a financial report on clean energy technologies, or CETY. It digs into this huge tension between a massive new $10 million contract win, which is great news, and some pretty weak Q3 financials.
Right.
We're going to jump right in on how to sharpen the analysis of what comes next for them. So the report, it really does a good job flagging the core problem. CETY's got, about $1.06 million in cash?
Yeah, something like that.
But their quarterly burn rate is over $2 million.
The math is, yeah, it's not great.
And the report correctly points to a high risk of stock dilution. But I think we can make that connection, between the good news and that dilution a lot more urgent.
I agree. I think we need to completely reframe how we talk about that dilution. The presentation of the company's critical cash position needs to be integrated more forcefully with the immediate capital demands of the new $10 million contract.
Okay. So you're saying the report treats it like a chronic condition, like just a standard balance sheet problem.
Exactly. It's presented as this ongoing issue.
Instead of an acute right-now obstacle to actually starting this $10 million deal.
Precisely. The weakness here is that it talks about dilution risk as, a typical feature of a microcap company.
Right.
But it fails to explicitly connect that risk to the actual physical necessity of funding this project. You can't just win a massive contract for a battery energy storage system and, show up with empty pockets.
You have to buy the batteries. You have to pay the engineers.
You have to secure those long lead items. And with only $1 million in cash and a $2 million burn rate, they just can't cover even the most basic upfront costs.
So the dilution isn't some potential outcome of bad financials down the road.
No, it's the trigger. It's the thing they have to pull to even get started. The suggestion is to reframe its whole narrative. The $10 million deal literally requires an immediate capital raise.
Which turns the dilution from a high risk into a near-term certainty.
A certainty. And it's directly tied to the good news. That 116% stock pop isn't just traders having fun. It's the company's one and only window to get this project funded.
Okay, so how could the writer make that more concrete? Give it some real teeth.
Well, the best way is to quantify it. You need to estimate the initial capital outlay for this 5MW20 MWHBESS project.
Right.
Just make a conservative estimate. What percentage of that $10 million deal do they need on day one?
I mean, for a project like this, with supply chains being what they are, you could easily be talking 30, maybe 40% upfront just to lock in your hardware.
Okay, let's use 40%. That's a great example.
So that's $4 million.
$4 million. And now you show that number right next to their cash on hand, which is $1 million.
So they're $3 million in the hole before they've even broken ground.
Instantly. And that calculation right there, it transforms everything. The dilution isn't an abstract fear anymore. It's a quantified operational necessity. The reader needs to see that math. $1 million in cash minus $4 million in immediate need equals a crisis that only dilution can solve.
It shows management is actually being strategic, using the rally to fund their biggest win ever.
Exactly. It's foresight, not just a weak balance sheet. All right, let's move on to the conclusion. The report's title asks, is the rally sustainable? And the verdict is low-medium speculative. But then it pivots really hard into technical trading levels.
Yeah, it does.
It starts talking about watching 180 and 150 for momentum failure.
And this is where the analysis, I think, loses its way a little bit. The verdict and forecast section currently reduces the analytical depth by mixing long-term fundamental sustainability assessment with immediate, short-term technical trading signals.
I see why they did it, though. I mean, with the 116% rally, the technicals are what every short-term trader is looking at. But I agree, the shift feels abrupt. And that's the weakness. You spent all this time on a deep dive into the business, the burn rate, the contract, the capital needs, and then the final word is about a chart pattern? By putting so much weight on those price levels in the sustainability section, it really muddies the water. It distracts from the core question, which is, can the actual business support this new valuation?
But can you really ignore the technicals here? I mean, the timing of that direct offering we just talked about is completely tied to those stock levels, isn't it?
That's a totally fair point. And no, you can't ignore them. But the solution isn't to just throw them all in the same bucket.
Okay.
The suggestion is to bifurcate the analysis. Just split it into two distinct conclusions for two different audiences.
2 buckets. I like that.
Exactly. One section is purely about fundamental sustainability. That's the long-term question. Does this deal change the company's trajectory for good?
And the other is?
The short-term trade. That's where you talk about the market mechanics, the timing of the offering, the support and resistance levels. You give each analysis its own space.
So how do we sharpen that fundamental sustainability piece then? Make it less speculative?
We need to define it with clear metrics. A sustainable outcome isn't the stock holding $1.80. A sustainable outcome is, for example, the company successfully executing this contract at a 15-20% margin.
Okay.
And it's using that to get visibility into 2026 revenue. And most importantly, it's getting that quarterly burn rate down to 0 after they raise this initial cash.
So sustainability has to be defined by the P&L, by the future pipeline, not the stock chart?
Correct. The chart is just telling you the best time to raise the money you need to try to become sustainable. They're related, but they are not the same question.
Okay, final point. Let's look at the bear case. The report makes a really strong point about execution risk. You've got this tiny microcap taking on a project that's 5 times its entire last quarterly revenue.
Which is a huge red flag.
Yeah, a massive risk of delays, cost overruns. But like our first point, it feels a little bit qualitative. It's a good warning, but it could be stronger.
I agree. It's a powerful idea that needs numbers to really land with force. The crucial execution risk needs to be structurally integrated with the financial projections by stress testing the assumed contract margins.
So the report says, delays could turn this win into a financial burden, but it doesn't quite show you the math on how that happens.
Exactly. The weakness is that the connection isn't fully drawn. It's an implied threat, but we need to make it a measured consequence. We need to show that a small execution failure doesn't just mean a little less profit.
It means
they have to go out and raise more money through even more dilution because the cash burn problem doesn't get solved.
Okay, so the suggestion is to run a sensitivity analysis using that 15 to 20% margin from the bull case as a starting point.
Precisely. You anchor it there. Then you model what happens if that margin shrinks. Let's say it drops from 15% down to 5% or even 0 because of supply chain problems or labor costs or whatever. These things happen on big projects.
Okay, so let's walk through that. On a $10 million contract, a 15% margin is $1.5 million in profit.
Right. That's the best case scenario. That helps plug the hole in their cash flow.
But if the margin drops to 5%, now you're only making $500,000.
That's a $1 million swing, $1 million shortfall from what you were counting on.
And that difference has a huge impact on their $2 million quarterly loss.
A massive impact. You have to show the reader that that $1 million difference has to come from somewhere. And there's really only one place it can come from.
Another round of dilution.
Another round, probably at a lower stock price too, because the initial excitement will have faded. It shows how this winning contract can quickly become a tightrope walk.
That's the key linkage. You're moving the risk from a general warning to a quantified financial threat.
It's the difference between saying this is risky and showing exactly how many more shares the company will have to issue if the project margin slips by just a few percentage points. For an investor, that's incredibly valuable information.
This has been really, really insightful. I think the material that was submitted is already quite strong. It does a great job identifying that core tension, right? The massive deal versus the precarious finances.
Oh, absolutely. The foundation is solid. But we've hit on, I think, 3 key ways to really elevate it. First, just integrating that urgency of the capital raise, making it clear it's a prerequisite for the contract.
And second, creating that clear separation in the conclusion. The fundamental business sustainability versus the short-term trade. 2 different questions, 2 different answers.
And finally, putting hard numbers on that execution risk. Stress test the margins to show how quickly the dilution problem can get worse. I think if those steps are taken, this report goes from a great overview to a really predictive, powerful piece of analysis.
We really encourage the listener to make these changes. And please submit your improved work back in for a follow-up.